All right, team, it is time for the Jerome Powell interview coming up pretty soon. We'll see what we get. Hopefully, we get some good data, some good movement here. All right, so this is an interview with David. With the Economic Club of Washington. Let's get this going here. Should be fun. Also going to send out a newsletter like we always do. Also going to do a Twitter poll today. Should be fun. Let's see what we get. What's up, team? Yeah, puts or calls or puts, bull or bear. Hey, you guys know how it goes here. You know, to be honest, like every time I'm listening to music off stream and I turn the stream on, I get kind of sad because I got to turn my real music. I was listening to Lil Wayne. Now I got to turn it off and listen to, you know, instrumentals. But that's all right. I like the instrumentals we play here regardless, but... Yeah, we're almost at 100K. Almost to 100K. But yeah, SPY looking good again today, man. Another day where the market just going pretty green. SPY up to 410s here. The Dixie has been falling down since the opening bell. We were up on the day so far. Yeah, we are almost to 100,000. Yeah, Anthony, man, best thing to do, bro, is just to, like, again, don't get stuck day trading penny stocks, brother. Again, there's just risk there, man. What I would do is I would trade futures. We're going to do a poll like we always do. So again, we're going to do a poll here. Vote on the poll. Bullish or bearish on today's Jerome Powell interview. Bull or bear? Vote on that poll here. Let us know what you guys think. Is that how you spell Powell? Let me make sure I spell this right. 2 L's, double L. All right, we got it. Vote on that poll. We're also going to do a Twitter poll like we always do here. Also, do me a favor, hit the like button. It helps more than you know. We appreciate it. All right, guys. So calls or puts is going to be the Twitter poll choice. Calls or puts. We're going to make this only a couple hours long. We got that poll live too. It's 12:40 Eastern Standard Time, so it's 11:45 right now. We still got about an hour, but yeah, it's Eastern Standard Time. All right, about 71 votes so far, about 56% saying bullish, 45% saying bearish here. And again, we'll see if we get anything good today, man. I'm excited. Hopefully, he says some positive things, man. But again, I just don't know if he's going to say some positive things. Yeah, end phase earnings this evening. We got some votes here. Looking at our Twitter page. Give me a vote on Twitter. We're also going to send out our newsletter as we always do here, team. It's a Twitter poll. We got this up. SPY looking strong today too, man. Will the market continue pushing up, I guess, is the real question here. We got the link working. All right, market just broke highs again. Again, hit me that subscribe button, guys. Hit the notification bell. We certainly appreciate it. Sending out these newsletters now. We still got a little bit of time before this, but it's all good. We are on the wait screen here. Meeting starts at 12 to 12:40. I'm not sure which one, so we started early. Dixie breaking lows. All right, sending out the newsletter now. So the actual speech is supposed to start at 12:40, which is in less than an hour. Less than an hour. So yeah, it's 11:40. It's 11:50 right now. So we still got a little bit of time. We're starting early like we always do. Looking at our poll numbers here, we already got 130 votes. Please split. 53% think bull, 47% think bear. Feels like a trap. Got tight stops. Hey, good luck, bro. February pump. Hey, we'll see, Iron. Market's looking good. All right, so market's testing highs. Dixie just broke lows. We might trade a little bit. We'll see. I predict Powell announced in a place of dark. Jerome, do you know what time any ENPH drops the number? Yeah, so ENPH is going to drop their earnings report. So yeah, ENPH is supposed to drop their earnings report this evening at 4:05 p.m. exactly. At 4:05 p.m. exactly is when ENPH in phase drops their earnings. Chipotle drops theirs at 4:10. VRTX at 4 on the dot. Paycom at 4:05. Most of them are at 4:05 or 4 p.m. except for Chipotle, which is at 4:10. So that's when the actual earnings drop. The actual earnings call for that will be a little bit later on, probably about an hour later than that. Yeah, all good, Tamir. No worries, bro. Again, do me a hit the like button, guys. Help me hit 100 likes real quick here on the stream if you haven't already. Everybody do it now. Yeah, we'll see what happens with Chipotle numbers. I'm gonna send this to our Discord members. Hit them likes, peeps. Hey, thank you, team. Glad I grabbed Microsoft. Yeah, I should have taken it. Again, I had that theory a few days ago, but I just waited a little bit too long, I guess, to take that trade, but it's all good. I wanted to buy it, but like, again, I just waited and it's all good. Again, I'm waiting for this to happen. I don't know how much this is going to affect markets, but I wanted this to pass first before we took anything big on that. You know what I mean? So we got time, but I'm also going to pivot to my AirPods pretty quickly here, but for now we got this one. I got my cough drop. I might need to go get some water. Yeah, what's y'all's predictions here? Again, we did our Twitter numbers. We got about 30 votes already. About 43% say call options. About 57% say put options here. So, how much are we expecting to move? But I really don't know. I hope we get big movement, but again, I really genuinely just don't know. You know, we are waiting on live though. We got everything up. We're gonna stream the entire thing as we always do. I might as well join that meeting here too. I'm gonna go ahead and join the meeting. Apple flying up today, almost to 154s right now. Microsoft flying up to at 264s too, man. So just big movement here. Again, here is the here's the actual weight. Yeah, we'll see, Damien. I just have so many people yelling crash that I'm just super skeptical. Anytime I hear somebody be like, yeah, there's gonna be a crash, it's like, is there really though? You know? But we are up ready here. You see the SPY popping up big today, almost at 411s right now. I don't know if it's going to be a bear market. I'm definitely gambling by calls. Like I said, BBBY. Yeah, man. Again, try out futures, man, and try out a funded account program for futures, right? Like that's a great test for yourself. I'm biased. Like one of my sponsors is a funded account program, but regardless of whether you use my sponsor or not, like the funded account programs are useful because they can ultimately test your skills so you know whether you're ready to move up with real money. So you don't end up losing your butt in real money. You can try these funded account programs and futures. You're essentially day trading the S&P 500. Like I think that's super useful because, again, without that, you're going to be really struggling to get around the PDT rule, and it's just kind of a pain, you know? Yeah, let's get our timer up here. Right now, it is 11:55 market time. So really, we've got about 45 minutes exactly. I'm just going to call it 45. There we go. Actually, I'm going to make it super exact here. All right, so we're going to make this super exact. So we're going to make this 44. No. Time is it? Yeah, we're going to make this 44 and 10 seconds. That's super exact. This is the real timer. All right, we're going to put that thing right there so you guys can see it. So I'm going to minimize this. I'm going to put one chart up. And we're going to put stacked on top of each other. We're going to put the Dixie at the top. And Dixie at the bottom, SPY at the top. So here's the SPY. Here's the Dixie. So you can see how the dollar is getting affected by this meeting. Maybe put Bitcoin up there occasionally too if we find something that looks good in that regard. But yeah, that's what we're at. And we got over 410 people here. We're getting there. We're getting there. We got the meeting waiting. Top Step base package is about 140 bucks, Anthony. And again, I don't want it to seem like I'm just shilling a sponsor. I mean, I kind of am, but like, I think those funded account programs saved me money because I think I was like you when I first started trading. And like, I have a 30,000, 120K BP account on TOS. So it's like, I'm a little bit different, but if I could start over, I wish I would have had one of those funded programs. If you want to check it out, you can find the link in the description. But again, if I could start over, I wish I had one of those because I would have just saved myself money, man. Yeah, we're going to be playing the Jerome Powell speech live, of course. Yeah, we're not going to be talking during the speech, bro. We never do. We cover all the major stuff here. We don't talk during any of the speeches, bro. If you want it super live Gab, you're gonna have to sign up. Yeah, I'm a bull. I mean, I'm asking anybody here. I've been arguing with bears all week, bro. Bears like, market's gonna crash tomorrow. The market doesn't crash tomorrow. Market's, oh well, timing's a little bit off. Market's gonna crash next week. Next week comes up. Market timing's a little off. Market's gonna crash next month. Up, timing's a little off. Market's gonna crash next year. Next year happens up. Timing was a little off. It's like, bro, you throw darts at a dartboard, eventually it's gonna hit it. You know what I mean? Doesn't mean you were right though. Even if we do crash at this point in time. What's your thesis for no crash? Okay, no offense, Derek. You've heard my thesis before, bro, and I know you're short and you're bearish, and I get it, right? And again, my thesis, okay, number one, it's like innocent until proven guilty here. Like, I think we need to argue why there is going to be a crash more so than we need to argue why there's not going to be a crash, number one. So I think you got the logic backwards. And it's all love. I know you're supportive, bro, and you're just taking your side. And I get it, bro. No, like I said, it's all love here, man. It's all, like I said, I could respect the fact that you've always been pretty respectful with me, but still, regardless, I think you need to argue why there will be a crash more so than why there won't be a crash, because normal circumstances means there's no crash. All right, so here it is. Let's see. Let me make sure I got my auto settings.
Okay.
Can y'all hear? Sound check. 1 2 1 2. I'm gonna mute the music.
Okay. Can everybody please take their seats?
All right, here we go. Can y'all hear this? Good. Yeah, I got you, Derek. Hold on.
Well, I didn't expect such a big turnout for my opening remarks, but thank you. So, everybody, I'd like to welcome you as the chairman of the Economic Club of Washington. This is our 6th signature event of our 37th season. And everybody is here because our featured speaker is the Honorable Jerome Powell, Chairman of the Board of Governors of the Federal Reserve System. Thank you very much, Jay, for being here. And
JP.
I will have a conversation with Chairman Powell right after lunch. Let me first recognize some ambassadors that are here. The ambassador from Singapore, Shak Murpuri, is here. There you are, head of our Economic Club Diplomatic Advisory Council. Ambassador from Switzerland, Ambassador Pitalou is here, right here. The ambassador from Liechtenstein, Ambassador Sparber is here. Thank you. And the ambassador from the Republic of Indonesia, Roslani, is here. Where's he here? There he is. And let's see. And the ambassador from Slovakia, Ambassador Javorčík, is here. Okay. And everybody else is here is also very important. So let me just make a few announcements very briefly. We have a signature dinner event on Tuesday, February 21, featuring Robin Hayes, Chief Executive Officer of JetBlue. So how many people here fly JetBlue regularly? A lot of people? Okay,
No,
well, if you have
not
any
me
questions,
personally.
send them in to me and we'll have a conversation with him. We have a signature dinner event on Wednesday, March the 22nd, featuring Jane Fraser, the Chief Executive Officer of Citi. And executive conversation luncheon on Wednesday, the March the 29th, featuring Tamika Tremalio, who's the Executive Director of the National Basketball Players Association, interviewed by Barbara Humpton. And executive conversation luncheon on Thursday, April 20th, featuring Steve Bolin, Chief Administrative Officer of the Bank of America, interviewed by Larry DeRito. So watch for your invitations. And I'd like to invite Barbara Humpton, the chair of the club's global initiative and CEO of Siemens USA, to give us an update on our international program. Okay, Barbara is, there you are. Okay.
All right, guys. So we still got, just to put this into perspective, we still got about 45,
Thank you, David.
40 minutes,
The Economic
30,
Club
45
of
minutes.
Washington's Global Initiative offers our members, many of whom represent businesses with extensive global interests, the opportunity for increased international exposure through our various programs. The initiative also encourages ambassadors to engage directly with the club members to discuss matters of international importance by participating at signature events like today and serving as hosts for global executive conversations. In recent years, the global signature events have featured world leaders, including the prime ministers of Finland, Israel, and Singapore, and the presidents of Colombia and Panama.
12:40
In the last
Eastern.
10 months, we held
Jeff.
4 global executive conversations featuring His Excellency Marek Magierowski, Ambassador of Poland, Her Excellency Emily Haber, Ambassador of Germany,
How do I get
His
that title?
Excellency Philippe Etienne, Ambassador of France, and Her Excellency Dame Karen Pierce, Ambassador of the United Kingdom. The Economic Club's Diplomatic Advisory Council solidifies our outreach to the diplomatic community while raising the club's international visibility and ability to attract speakers from foreign countries. Ambassadors, many of whom you've already met here, and others are acquainted with the Economic Club and its programming, and they serve as members of our Diplomatic Advisory Council. And the council, we are pleased to see, is headed by Singapore's Ambassador Murpuri. Watch your inbox for invitations to upcoming global events. Now, please enjoy your lunch. David and Chairman Powell will begin the program soon. Thank you.
All right, guys. So we got 40 minutes, guys, 40 minutes. I changed my name. How do I get that title, Sir Excellency? I want that title. I changed my name to Sir Top 3 here, Sir Top 3. We're still waiting on this to start. I did change my title to Sir Top 3. You know, we'll see if that means anything good. How do I mute this until the time starts here? But as long as y'all can hear it, we're doing well. We got 35 minutes before this starts. Yeah, I saw a lot of people talking about this. Michael says, I think this month's CPI report, which is February 14th, Valentine's Day. What a Valentine's Day surprise. Will make or break the market. If it goes down, the sky's the limit. If it's higher, we might see new bottoms. Yeah, the CPI report is wildly influential over price action. You know, the only other arguably more influential thing over price action than the CPI report is Jerome Powell speaking, number one. The Fed rate hike decision and the press conference that accompanies that, right? Those are the only other things that arguably might be bigger, but generally here on this live stream, the biggest stream we ever do is CPI streams. CPI streams, we get so many people here, thousands and thousands of people. You know, we get like over 5,000 people here generally. But Jerome Powell's speech is the last Jerome Powell speech we had over or over 7K people here, 7,000 people watching with us. So again, wildly influential market data. And that's going to drop. That's going to drop next week. You jerks. All right, so we had to mute it. They started playing music here. I got to figure out how audio settings. How do I mute this? Bear with me, guys. I got to figure out how to mute the music they're playing here. Let me see audio settings. I guess we turn this bad boy down. All right, so can y'all hear the music now? Let's do a check. I'm gonna just turn that down for now. We'll turn it back up when they start. But we're turning that down for now. Again, can y'all hear the whole music right now? Anyways, going back to my argument here on why we don't crash, right? Again, I'm going to preface this whole entire argument with, like, I have no idea. Anybody that's honest is going to say, hey, I have no idea what the market's going to do. Nobody does. We could speculate, we could guess, we could argue different reactions and different, catalysts in the market and all this stuff. But like in the end, the basic truth of it is that nobody freaking knows what's going to happen. Nobody does. They might guess right. They might guess wrong, but nobody knows if the market's going to crash, rip, or stay flat. Okay, nobody does. We can speculate and guess on it, but nobody really knows for sure. And so anytime I hear somebody say we are going to crash or we are going to hit X level, I immediately look at you with skeptical eyes, like this person has his own agenda. That's the first thing I do. Number two is that we're down over the last year. If you look at the SPY here, number one, bear markets generally don't last forever. The market has been red for over a year now. We are red on the year. We are down on the year. In 2020, with the C word hit, that tanked markets. It caused supply problems, shipping problems, import-export problems. That drastically affected the market, and that made the market fall in 2020. If you look back over the last 3 years, that certainly affected the market negatively. At this point in time, those things are starting to get better. Obviously, one of the runoff, spin-off effects of all of this stuff was bad inflation, which you're currently experiencing right now. And inflation's bad. It's not an argument for me here. Inflation's bad, right? That's obviously the case. Inflation's definitely been bad. The real estate market's been bubblish over the last few years. But the problem here is that if you look at what the Fed is saying and what the Fed is doing, they're all showing signs of those things easing up, right? They are doing lesser and lesser rate hikes. They're not being super aggressive with 75 plus basis point rate hikes. The market's been down consistently for the last few years. And when you hear Jerome Powell talk, he said not this last Fed meeting, but the Fed meeting before that, he said specifically that he did not want to spark a crash from raising rates too aggressively, like if they did 100 or more. He didn't want to spark a crash and then have to play cleanup afterwards. That's not what his goal was. That obviously he wanted to do a soft landing. And so in that regard, he doesn't want to cause a crash, number one. My guess is he doesn't want to crash under his watch. He's the Fed chair. He doesn't want the market to crash when he's the Fed chair. That's going to make him look bad. And so he said what he plans to do was to do continued rate hikes, but not so aggressive as to cause market crashes, and sustain those rate hikes until they start to see signs of inflation that are easing, but as to not cause a market crash or a recession. And it's arguable whether we're in a recession or not. And then when you hear what he said during the last Fed meeting, number one, they did a lesser rate hike than the previous one with 25 basis points. He also said he showed optimistic signs that inflation was getting better. So basically, the way you could look at this, and again, I'm not saying this is for certain. I really don't know. Like, I don't know what the market does. We might crash. I'm pretty neutral in that regard as well. I'm just giving you the bull argument here. If Jerome Powell does what he says he's going to do, which is sustained rate hikes, but not super aggressive to kind of chip away at inflation over time without causing a crash. He said inflation numbers are getting better. If you look at CPI, PPI, all the inflationary metrics that we generally look at, they are all showing signs of improvement over the last 3 months or so. They were much worse. Inflation was almost 8% with CPI 4 months ago. And then since then, we've seen lesser and lesser CPI reports. We've seen lesser and lesser PPI reports. We've seen all the signs of positive inflation, growth, like lower inflation. And so if that's the case, then we might continue to bounce back. And the market has as well. And I understand the bear argument. I understand there's a lot of Burry clones out there that just think the market has to crash, right? But if you saw what Burry did, Burry told everybody to sell it ahead of the Fed meeting, like the Fed was going to do 50 or 75 and the market was going to crash. And then the market didn't crash. And then Burry deleted his Twitter. And then when he saw GDP come out slightly worse than expected, he reactivated his Twitter, probably in an attempt to say, I told you so. And then the market ripped up anyway. And so then he's just been kind of silent. So I guess my point is the market doesn't have to crash here. It's not something that has to happen. There are arguments for a bull rebound. There are arguments that all the things that made the market dip over the last few years are starting to ease and get better and better and better. I know it's arguable whether ripping the Band-Aid off and doing a super high rate hike is the better or worse decision. I'm not here to argue that. I really don't know. And I'm not here to argue whether the market crashes or not. But what I am saying is that the market doesn't necessarily have to. And I think I've seen a lot of bears get really mad, call bulls names, and the market has been mostly pushing up. Like I bought Snapchat a few days ago. It ripped up 15% right after I bought it. At the time I bought it, I got made fun of constantly for it. Same thing with Microsoft. People said, what are you doing, bro? What are you thinking? Buying Microsoft. Microsoft pushed up heavy after I bought it. And so at the end, I guess the point is, you got to make your own trades and you got to tune out the bears sometimes, because the bears are going to be yelling the sky's going to fall. They've been yelling it for the last 5 years since I've been streaming. Every year, if you look at what keywords are trending, 2020 market crash, 2021 market crash, 22 market crash. And so again, maybe we do crash this year, but I'm not going to hold my breath for it. I'm not going to take big extended gambling positions betting on that, trying to be Michael Burry. Like, that's not what I'm going to do. Again, it's just not my style. And maybe the market does crash and maybe I miss out on those gains, but so far I'm not convinced. Anyways, all right. Let me free up and hear the music. I'm gonna play some music here. Yeah, maybe we correct. That's certainly possible. No, the speech hasn't started yet. Speech starts. You can see the timer at the top left. We're at 27 minutes until it starts. Yeah, puts and calls ratio. I mean, you can do that too. I mean, like I said, it's subjective. It's all up to you guys. It doesn't matter to me. Yeah, I'm gonna switch to my AirPods that I've been charged real quick before the speech. There we go. We're going to do a sound check here real quick too. I'm going to stop sharing this, and then we are going to switch to the audio back to this. There we go. Can y'all hear? Let me play the music. Can y'all hear the music right now? Let me know if you can. No, Powell hasn't spoken yet. He doesn't speak for another 25 minutes or so. And I know there's also bull or bear arguments. Like, I understand. There's arguments for the downside. I understand that, I understand those arguments. But again, all I'm trying to say, and maybe they're right. Like, maybe the market does crash. All I'm saying is that it doesn't necessarily have to. And I got a lot of people here saying the market has to do this. And they've been saying it for the last 4 years. You see all these doomsday YouTubers talking about sell now, do this, and then when they're wrong, they blame it on manipulation or they blame it on whatever. And it's like, maybe y'all are just wrong about this. Crashes are very difficult to predict. Everybody's not Michael Burry, and everybody wants to be. And at a certain point, I think that influences their bias. But maybe we do crash. Like I said, it's possible. Can y'all hear the music? All right, cool. Yeah, but we can argue accurate data. We can argue manipulation. I think the only way to really do it is just go by the data they give us. Like that, saying we don't have accurate data can completely discount any argument on any side, right? You can say, oh, well, the market's going to crash because of this data. And I could say, oh, well, the data might not be accurate. It doesn't necessarily mean, anything in that regard. You know what I mean? Right. And yeah, again, maybe it does, maybe not. Yeah, all good, Derek. Like I said, man, it's all love here, bro. Again, we can agree to disagree regarding that. But to be honest, for y'all to really understand my stance, I really have no idea what we're going to do. I swing trade mostly, and I'll hold blue chips long term. But like, I have no idea what's going to happen. No idea which way. Like, the market might crash tomorrow. The market might break 420 tomorrow. I don't know. I try to stay pretty neutral because I don't want to influence. Because I'll tell you why I try to stay neutral. Is because there have been times like yesterday, I tried to buy Microsoft and my whole entire chat room basically was like, nah, don't do that, bro. Don't do that. Microsoft's that's a risky bet. The Microsoft's going to turn against you. The market's going to drop. Don't buy Microsoft. And so I didn't. And then Microsoft ripped up big. And so I don't want to do that to other people. I would rather just say, yo, I have no idea what's going to happen. And then that way they can take their own trades based off of it. Because what I've realized is that bears are generally more emotional than bulls, right? People betting on the short side and predicting market crashes are generally more emotional. They want to see the world burn to a certain extent. And, that makes them overestimate the likelihood of it doing so with confirmation bias. So again, if I would have listened to the bears, I would never take any positions ever over the last 5 years on the long side. And I just don't want to do that to other people. I'd rather just tell people I don't know. I'll tell people my own bias with specific stocks, but with the broader market and which way it heads, I don't know. I do like Burry. I think Burry's prediction in 2008 was great. But just because I like Burry doesn't mean he's beyond criticism for how he's been behaving over the last few weeks. Telling everybody to sell and then being wrong and then deactivating your Twitter. I mean, he's not above criticism. Like, I like Burry. I love The Big Short. Great movie. Genius in some regards in 2000s. But he was wildly wrong about this last few weeks. And again, I think you got to look at it objectively and not idolize or put him on a pedestal, Yeah, we're going to put it in sub-only mode, guys. So, and listen, my big thing here is, like, I don't claim to be an expert. I don't act like a guru. I don't charge for anything. Like, I give everything away for free. We don't claim to be experts. Like, I don't want to act like experts here. Like, we don't sell a course. I don't even claim to be a good trader. We all just put everything out there for free. We cover market data fast, CPI, PPI, jobless claims, retail sales, Jerome Powell press conferences, rate hike decisions. We stream all the major earnings like Netflix, Tesla, Disney, Apple, so forth and so on, as well as the big one earning calls as well. We cover the big earnings calls as well. We stream it completely live, and we just try to give people a reasonable outlook in terms of market news and data. Right. It's always best to be a long-term bull. I think the biggest edge you have in stock market history is Warren Buffett's value investing. Diversifying into blue chip healthy companies, and they need to be blue chips. They can't be penny stocks. They can't be mid caps. Diversifying into blue chip healthy companies that are obviously going to be around in a decade, and then buying those, diversifying into different ones, and then sitting on them for years is the single most effective trading strategy in the world. If you do it right, you're almost guaranteed to make money. And you got everybody trying to predict a short, like a market crash. Even if we do crash, generally bear markets don't last forever. And throughout history, the people who lose the most during market crashes are people who get emotional and sell. Generally we rebound with it a few years back up to where we were beforehand. Not always. There's been outliers to that logic, but most of the time. Dollar index is still falling here. And again, you can see the SPY. Green day over 410. Yeah, 100%, Chris. I absolutely agree. He's tried to predict this crash too many times. He's tried to recreate 2007, 2008. But again, he's been wrong like every time. at this point. And so I think he's trying to ride the coattails of what he did back then. And I like Burry. I think it was a genius move back then. But I think now you got a bunch of people trying to mimic him, and it's influencing. They're not taking advantage of the biggest edge that you have, which is long-term growth and healthy blue chips. And instead, they're just trying to predict a short crash every year. And that's just, again, those are suckers' bets most of the time. You know, even if they are right now, the same people probably predicted it every year. All right, so the image switched. We still got about 20 minutes. Hey, thank you, Chris. Yeah, maybe he's right today. Maybe it'll come out he was right. I don't know, man. We'll see. Best stocks to buy after the market crashes? I would buy, if the market crashed today, I would probably buy up Disney. I'd buy up Apple because people are still going to watch Disney and buy phones regardless of the economy. Walmart, you know, I think those are probably the ones that I would buy. Walmart, Disney, Apple, you know, stuff like that. But again, completely, I don't know about Target. Target's a little bit more expensive than Walmart. And so I think if the economy is struggling and people are struggling, I think a lot of them are going to go to Walmart as opposed to Target. So I think Target's a little bit more risky, but I still think it'd probably be fine. Apple is more expensive than a motorcycle. Yeah, but arguably more useful in some ways than a motorcycle too. You know? Yeah, I know they don't crash in one day. I just meant like if we were in the middle of a market crash right now, that's what I would buy. I didn't say Amazon. Amazon's PE ratio is too high for me. You know, Amazon's got like 100+ PE ratio right now. It's way too high. I'm just not interested in buying that. Guys, will the speech also affect crypto? It might. Not in the way you think, though. I think it'll probably affect it because it's going to affect the S&P 500, and the S&P 500 influences crypto. I don't know if it's going to affect crypto directly. It's more so just going to affect broad markets, and then broad markets are going to affect crypto. If that makes sense. Hello, I'm new here. A few months ago, I bought Apple at 700. I think now around 200, please. I don't know. Yeah, I mean, Apple has dropped pretty big percentages, I guess. Has it dropped that much, though? You know, what is that? That's like 20-something percent, low 20s percentage-wise. Has it dropped that much over the last year or a few months? I don't think so, right? Yeah, 180-day chart's pretty flat at Apple. You know, it lost maybe about 30% from August to early January, but it didn't lose that much. The math's not adding up there, bro. How much cash do you trade with? My TOS account's got like cash like 30K, buying power like 100 and something. Yeah, crypto's been following the SPY for a while, really. Apple pulling back to test the volume weighted average price. SPY at 409s, 410s. All right, guys, we got 15 minutes. 15 minutes. Let's see what we get. Again, hit that subscribe button. Help me hit 100K, man. We're pretty close, dude. We're so close. I'm about to get Carol to make me some more coffee. All right, we're at like 99.3. We need like 700 subs here. 700, guys. Come on now. Hit the subscribe button. Hit the notification bell. We're going to be so close to hitting it. So close to hitting it this week. So if you haven't yet, hit the sub button. Hit the notification bell. We got 1,500 plus people here. So listen, if just half of you guys subscribe, and I know half of y'all aren't sub, do it now. Like I said, my big thing is I don't sell a course. I don't sell a service. I think there's too many penny stock gurus out here faking money, trying to sell courses to new traders. I try to just put out free content. I don't claim to be a good trader. I don't claim to be an expert. I trade live every day. We've been doing this for years. I'm green on the year. I paid capital gains taxes for last year, or for the year before last. I'm sorry. And so, hey, subscribe, hit the notification bell, guys. We appreciate it. We cover all the big data. We cover CPI, PPI, jobless claims, retail sales, all the big earnings, economic data, Jerome Powell press conferences, rate hike decisions. And we stream it all completely live. We break it down as we do it. Hit the sub button. Do it now. I would never pressure you to, but I'll hate you forever if you don't sub. And I certainly appreciate the support, guys. 15 minutes. Wes. Do you think the VWAP fade and bounce are applicable in crypto? Not super applicable. And again, the reason why, Lazar, is that a lot of times cryptos moves in ranges. The other thing is that like the liquidity is so much lower in crypto than it is in stocks or futures that it's going to be really hard to get consolidated volume around the volume weighted average price, if that makes sense, right? So if you look at a crypto chart, it's just not as liquid. If you pull up Bitcoin right now and you zoom in on a 1 minute, it's just not as liquid. Yeah, what's up, Bacon? Top 2 non-subscriber haters in the world right now, for sure. Definitely top 2. I'm gonna get a plaque on my wall. Top 3 greatest whistlers ever. You know. Eduardo, yeah, he says, does anyone know a website to catch this news live? Yeah, it's called youtube.com/beginner trading. You know, that's the best site right there. All right, team. We got our boy serving that. Look at that food, bro. That food looks good. Is that your boy Jerome Powell? There he is, right there in the middle. You can see his shadow. He's like Batman. You see him? There he is right there. That's him. Look. Wait. There he is. Lurking in the shadows. The man. We'll see what happens, guys. We got 12 minutes. Apple pulling back. SPY pulling back a little bit. What color tie, bro? I don't know. I can't see. He's sipping his cappuccino, though. Look at the man. You know, living life. What's he gonna say? I don't know. We'll see. Last week in a Fed meeting, interest rate up. So yeah, the way it works is like, depending on how bad inflation is, the Fed will raise rates aggressively in periods of high inflation. When they raise rates, your mortgage goes up. If your adjustable rate, if you're paying your car loan, that rate goes up. It's more expensive to get loaned out on cars and houses, and overall prices rise. Or overall, it discourages spending is what I meant to say. Inflation is prices rising, right? So overall, raising rates aggressively, like 75 basis points, some would say 50. But raising rates discourages spending. When spending is discouraged, people stop spending as much. When spending stops, then businesses must in turn lower pricing, and thus it combats inflation. That's the whole point of rate hikes, is to curb inflation, so to speak, right? And so depending on how bad inflation is, that is going to influence how much the Fed is going to raise rates. But it's a balancing act, because again, the more the Fed raises rates, the more the market's going to drop, because the more spending dries up, right? So really aggressive rate hikes will in turn cause really steep drops in markets usually, or it's all relative to expectations. And so say they expect 25 basis points like this last time, and say they would have came out with 75, that would almost certainly make markets drop, because it means that it's going to be more and more difficult ultimately to buy things. And so that's the nuance of the market. And so there really is a balancing act where, you know, they don't want to tank the market. It's called a soft landing. They don't want to raise rates so much to where it causes a recession from just, from super aggressive rate hikes, but they want to raise it enough to actually do long-term damage to inflation, to where it's going to actually help inflationary problems long-term, instead of just continuing with really high prices. So it's a balancing act, and that's the big arguable thing with rate hikes. And it happens every 6 weeks, and they base it off of the Fed. A lot of the time uses like PCE, which is the Personal Consumption Expenditure Index. But the public and retail and everybody else, broad market people, look at CPI, which is the Consumer Price Index. That probably affects the market more than any of it. PPI, so CPI is buyer inflation, PPI is seller inflation, and those drop monthly. CPI drops once a month, PPI drops once a month. Jobless claims, unemployment drop. Jobless claims drops weekly, and they also use a few other metrics, but they use all those metrics to figure out how bad inflation is, and then they raise rates or lower rates or do zero rate hikes accordingly. And so that's the procedure of the Fed. Yeah, there he is. You see him. What are your thoughts on scalping? I scalp sometimes. Futures, stocks sometimes too. Oh, if he comes out with a yellow bow tie, watch out. He's a crazy, he's a crazy person if he comes out with a yellow bow tie. You gotta just be careful. Yeah, I see the debt problems and all that stuff. Yeah, he's basically said the same thing, Eric, but what is Powell eating? I don't know. We got 8 minutes, guys, 8 minutes. Yeah, looking at our poll numbers here, we got a lot of votes on we got a lot of votes already here, so let's look at them real quick. All right, so far we have, do me a favor, hit the like button as well. Looking at our poll numbers, we've got about 2,000 votes. 53% are bullish, 47% are bearish on our specific polls here. We got a Twitter poll as well, and we're about 46-54 calls puts. So 46-54 calls puts. All right, we're at 99.3K, still pushing. Still got 7 minutes here, 7 minutes, team. Over 2,000 people here. Hey, all good, Raphael. Make sure y'all are live on the stream too, just to put this into perspective, team. You want to make sure you're caught up on the stream. If you're not, you're going to get the data late. You're going to get the speech late. You're going to get the reactions late here. So again, make sure you're caught up on the stream. The way you make sure you're caught up, on the stream, team. It sounds like a superhero. But the way you make sure you're caught up on the stream, team, is you click this live button right here. You see the live button next to the play button. You want to make sure this is red. If it's red, it means you're in real time. If it's gray or whatever it is, then you're delayed. You want to make sure you're caught up and hit that live button right there. That way you know you're caught up on the stream. Good cop, bad cop? Maybe. Well, I think how much does the market need to drop before we can be considered a market crash? Well, you can look at the S&P halt levels. What is that, like 3.5% and 7%? All right, so on Black Monday, October 28th, 1929, the Dow declined almost 13%. On Black Monday in 1987, the markets fell over 20% in a single day. In 2008, let's look at 2001. Let's look at the 2001 market crash. 2001 market crash lost about 16%. S&P dropped 11.5%, and Nasdaq dropped 16%. And then we can look at, and that was 01. That's what's called the .com bubble in 2001. And then market dropped 20% from its October 11th highs in 08. 20%. So if you want to do the math here, let's pull up our trusty calculator. So say the SPX right now, the S&P 500 is currently at 41. If you want to, if you're comparing it to the 2020 market crash, then if it hits 3280s, then that's 20%. 3280s. If you do 15%, then 3,500 roughly. You know, so essentially it would need to drop under the lows of the year, relatively short term, to reach that level. So if you look at the lows of the S&P 500 over the last year, right around 3,500, it's kind of, I think, the mark of a crash potential. Yeah, it's at beginner trades. Yeah, we're gonna put the Dixie chart up. We're just kind of showing you guys this for now. But when the meeting starts, we're gonna put the Dixie up and we're gonna put the SPY chart up as well. Yeah, it's at beginner trades. Yeah, DS, my guys on it. Thank you, Ben. No, you don't click the red arrow, man. Stop telling people to leave the stream, bro. Come on now, that's messed up. Doug from The Hangover. Which Doug, bro? Bro, I get people telling me I look like all kind of people, man. I think you probably mean I sound. Oh, no, you're right. Actually, my bad, guy. You are right. Doug from The Hangover. I've had people tell me I look like all kind of people. Some I like, some I dislike, you know. Sir Top John. Hey. All right, guys, we got about 2.5 minutes. No, I've had people tell me I look like Ryan Felipe is one that I hear a lot. I heard Forrest Griffin one time. I'm just not gonna pretend that one was real. I've heard a bunch of different ones, man. You know, I've heard the Irish Dragon, Paul Felder from the UFC. I've heard him. Zuckerberg, oh man, shots fired, bro. That hurts. That hurts. Which one's Doug from The Hangover? That's the one that got trapped on the roof, right, and got sunburned. Jim Miller? Jim Miller's been looking rough lately, bro. I think he got a W lately, though. I like Jim Miller. He's got Lyme disease, man. SpongeBob? Hey, that's me, man. Listen. All right. All right, we got a minute left, guys. A minute left. About a minute and a half. But hey, again, y'all subscribe, hit the notification bell, hit the like button. We appreciate it. We're covering this data live, as you guys can see it. We appreciate the love, Teeth, for sure. Help us hit. Again, listen, if subs get really out there today, we could hit 100K. We're at 99.4 thousand right now, 99.4 thousand. We get another 600 subs from you guys. We got 2,500 people here, you know. I'll take Ryan Reynolds. I mean, I don't see it, but like I'll take it, you know. Look at him. Jerome Powell living life right there. There he is. Hold on, let me see. There he is. All right, SPY over 410s. Dollar index is testing 103.70s. Seth Rogen? Oh, that's a new one, man. John Krasinski? Like Jim? We're an Office family here. I used to hate The Office. My wife and daughter love The Office, bro. They absolutely love The Office, man. And so when I first started watching The Office, I absolutely hated it. Right now, it's like my comfort show, and so we'll watch it. So I'll take Jim. I'll allow it. Now y'all are just throwing names out there. Oh, he is smiling. Look at him. He's happy. Oh, here we go. All right, here it is. Hold on. Let me make sure the music is up. Hold on. Bear with me, team. All right, guys. Sound check.
Being here. Why don't we start with an easy question? So you made a speech last week commenting on the FOMC's decision to raise the Fed discount rate by a small amount, relatively speaking, 25 basis points. Some people would say that was small. But at the time, it wasn't clear that the jobs report would be as strong as it turned out to be subsequently. Had you known that the jobs report was going to be as strong, would you have done 25 basis points or something different?
David, thank you for that question. And thank you for inviting me here today. It's great to be here. So we don't get to play it that way, unfortunately. We have to, but I'll take it this way. So the message we were sending at the FOMC meeting last Wednesday was really that the disinflationary process, the process of getting inflation down, has begun, and it's begun in the goods sector, which is about a quarter of our economy. But it has a long way to go. These are the very early stages of disinflation. So the services sector, really, except for housing services, pardon me, is not really showing any disinflation yet. So our message really was this process is likely to take quite a bit of time. It's not going to be, we don't think, smooth. It's probably going to be bumpy. And so we think that we're going to need to do further rate increases, as we said, and we think that we'll need to hold policy at a restrictive level for a period of time. Then comes the labor market report for January, and it's very strong. It's certainly stronger than anyone I know expected. And so, but I would say we didn't expect it to be this strong. But I would say it kind of shows you why we think that this will be a process that takes a significant period of time. The labor market's extraordinarily strong. And by the way, it's good. It's a good thing that inflation has started to come down without it. That has not happened at the cost of a strong labor market. So, and of course, since then, financial conditions have tightened significantly since then.
So let me ask it another way. So by the way, when the numbers coming out, the jobs numbers, 519,000 jobs, does anybody call you up in the government and give you a little heads up this is going to happen, or they never do that?
So on some data, sometimes we get data just the night before, and it's only me, and but not on all pieces of data. It's a very small amount of data, and we get it just the night before. For example, if we were going to get a big piece of data in the middle of an FOMC meeting, as often happens on the day of an FOMC meeting, it will help me to know it the night before.
Okay, so the markets, after your speech last week, the markets assumed that therefore there would probably be another 25 basis point increase in your next FOMC meeting. Was that a bad assumption by the markets?
So what we said at the meeting was that we believe that we anticipate, is what we said, that ongoing rate increases will be appropriate. And the reason is we're trying to achieve a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time. And we don't think we've achieved that yet. So we said that, and now you see the labor market report, and I think, again, financial conditions are more well aligned with that than they were before.
So the assumption when you made your speech was that probably the Fed might even consider decreasing rates by the end of this year, and the markets no longer assume that. You think the markets are wrong?
Well, so let me say, these are all of these numbers that we're throwing around here are conditional on incoming data and what happens. So we never say this is what we think will happen. We make a tentative forecast and then we let the data come in. For example, if the data were to continue to come in stronger than we expect, and we were to conclude that we needed to raise rates more than is priced into the markets, or than we wrote down at our last group of forecasts in December, then we would certainly do that. We would certainly raise rates more.
Okay, so today, for people who aren't familiar with the FOMC, who actually is on the FOMC?
So the U.S. Central Bank consists of a board of governors here in Washington. There are 7 governors. Those governors are nominated by the president and confirmed by the Senate, and we serve terms that are not synced up with the election cycle. So we're independent. There are also 12 reserve banks around the country which have a degree of independence, and so each reserve bank is led by a president who works there full time. All 12 of them sit on the FOMC. So that's 19 people sit on the FOMC. So it's quite a large committee, of which 12 vote in any given year. The Reserve Bank presidents vote on a rotating basis, except New York, which votes every year.
So when you vote, do you vote at the beginning of an FOMC meeting and then just kind of have discussions afterwards, or do you wait till the very end and then you vote?
No, we vote at the end. I mean, the FOMC meeting process takes, more than a full week. I'm talking to all of the participants, all 18 other ones, and staff has sent around memos, and there's something called the Teal Book, which is the staff's assessment of the of the economy and international economy and monetary policy and all that. Then we have an extensive discussion on the morning of the first day about the economy. Everybody talks about that. On the second day, we talk about monetary policy, and then we vote on monetary policy at around noon on the second day.
So does the chairman of the Federal Reserve Board speak first and say, here's what I think, or does he wait until the end and say, well, thanks for what you think, but let me tell you what I think? What do you do?
So
First or last?
different chairs have done it different ways, and so I've tended to do what my immediate predecessor did. I think. Well, this is what I do. I speak last on the sort of the economic go around. So everyone else talks about what they think about the economy and in their district, for example, if they're Reserve Bank president. And I listen to all that, and then I give my comments at the end, and I kind of sum up what people have said, and then I speak first on monetary policy.
Okay, so you've said your inflation rate target is 2%, but why 2% and not 3%? 3%, could be tolerable, really. I mean, for most of organized history, 3% is considered okay. Why do you want 2%?
So 2% is the global standard, and that is our objective. 2% piece as measured by the PCE index, and that's not something we're looking at changing. That isn't going to change.
That's not going to change.
Not going to change, no.
But okay, so you need to get the 2%, and your goal to get there is by what period of time would you like to get there?
Well, we say that we're using our tools to get there over time. If you look at our forecasts, we expect 2023 to be a year of significant declines in inflation, and it's actually our job to make sure that that's the case. But I would tell you that with inflation headline PCE inflation is running about 5%. This is on a 12-month basis. Core is running at 4.4. My guess is it will take certainly into not just this year, but next year to get down close to 2%.
Okay, so 2% is firm. You're not going to
Yes.
get off that.
Yes.
Okay. So the theory of raising interest rates is that it will decrease economic activity and increase unemployment. But you've been increasing interest rates for a while, and unemployment is now at a record low. So what's wrong with the theory? Why is unemployment not going higher?
Well, the labor market is strong because the economy is strong. And as I mentioned, it's a good thing that we've been able to see the beginnings of disinflation without seeing the labor market weaken. It's just that there's a lot of demand for workers. In fact, if you look at the supply of workers versus demand for workers, demand for U.S. workers is now more than 5 million greater than the available supply. And the available supply consists of people who were either working or actively looking for a job. So this was not the case before the pandemic. The pandemic really had a significant, left a lasting mark so far on labor supply in the United States. The labor force participation rate came down, and there now is a shortage of workers. And it almost feels more structural than cyclical. So that's a significant issue.
Now, you've resisted, I think, saying what unemployment rate would be acceptable to you, I think. But is there an unemployment rate that you think would moderate inflation such that you would tolerate unemployment at 4%, 5%, 6%?
I guess I think about it this way. You know, we have two goals that Congress has assigned us: maximum employment and price stability. Price stability, as we've agreed, is 2% inflation. Maximum employment means if you want a job, you can get one. So right now, the labor market is at least at maximum employment. But many would say that it is out of balance with more demand than there is supply. So what we're trying to do is get inflation down. We're not targeting you know, a different unemployment rate. We're trying to use our tools to get inflation to come down over time.
In hindsight, would you say that when COVID hit the economy and we injected $5 trillion of fiscal policy into the economy, and the Fed did quantitative easing and other related things, kept interest rates very low, would you say in hindsight that was a mistake or was the right policy at the time?
So I think you have to go back to the decisions that were made in real time. And it was something nobody had ever seen. The global economy came to a virtual standstill. People were talking about depression. People were talking, and we didn't think we had no idea when we would get vaccines that worked. So Congress took very strong measures and we took very strong measures. And you see where the economy is. You've got a very, very strong labor market, but you have high inflation. As I mentioned, we're at the beginning of getting that down. If you look around the world, though, at other countries, they're also experiencing high inflation, including countries that didn't do as much as we did, either from a fiscal or monetary standpoint. So that tells you, though, that a big part of this inflation is actually related to the pandemic itself, the shutdown and then the reopening. That's a big part of it.
Now, the quantitative easing program has increased the balance sheet, I guess, of the Fed. And what is your balance sheet now?
I think it's $8.4 trillion.
You must sound like you're pretty, you know. Sounds 8.4 trillion.
That was yesterday's number.
Okay, all right, 8.4 trillion. What would you like it to get down to over the next year or two? Is there some lower number?
So we are in the process of shrinking the balance sheet actively, actually passively, as I should say. So what happens is as Treasury securities on our balance sheet mature up to a cap, a monthly cap, the balance sheet shrinks in that amount. Same thing with mortgage-backed securities as they are prepaid or so the balance sheet is shrinking. In terms of the target level of it, we haven't put a specific dollar number on it. The idea is we're in a regime of ample reserves. Reserves are basically deposits at the reserve banks. And when we get close to that level where we feel that reserves are ample, kind of where we were before the pandemic, then we'll slow down and we'll sort of test where we are. But it'll be a couple of years, we think, till we get to that level.
The Fed does not sell securities. They waits for them to mature and then you just cash them in, right? You're not in the market selling securities that are not yet mature. Is that correct?
That is correct. It's also correct, though, that we've said we would consider sales of mortgage-backed securities, but I will tell you that's not something that is on the list of active things being actively considered.
So some people that are worried about the federal debt limit and that we might not be able to extend it on time. We have $31.4 trillion of debt. Are you a little worried about the debt limit not getting extended?
So the debt limit is really something for the fiscal authorities to deal with. The Fed, our only role in this is that we're the fiscal agent of the Treasury Department. We're not a policymaker on that. And I will just say this really can only end one way, and that is with Congress raising the debt ceiling in a timely fashion so that the U.S. can pay all of its bills when and as due. That's what has to happen. And if that doesn't happen, no one should think that the Fed has the ability to shield the financial markets or the economy from the consequences of moving too slow.
So you don't have any program in place ready to go if in fact the debt limit isn't passed in time.
This is something that Congress has to deal with.
And the so-called $1 trillion gold coin solution is not one you're in favor of, I guess.
As I said, this ends in only one way,
okay.
And that way is Congress voting to raise the debt ceiling so that the U.S. can pay all of our bills.
Okay, in terms of consultation, do you consult regularly with the Treasury Secretary or the head of the National Economic Council or the President of the United States? How do you kind of relate to the administration?
For a long, long time, 60 or 70 years, I think there's been a weekly breakfast or lunch with the Treasury Secretary and the Fed chair. And that's what I've had with treasury secretaries that I've had as Fed chair. I've also had, I have regular, or call it irregular lunches with the head of the NEC. We also have regularly scheduled lunches with the Council of Economic Advisors. And that's really that's the institutional structure of our contacts with the administration.
So in the way the Fed works today, if you could reconstruct the operations of the Fed, would you change the legislation anyway? Would you think the Fed operates in a way that's as efficient as you can realistically operate?
We're not looking for any changes to the Federal Reserve Act. I mean, I think it does work. The structure that I discussed earlier, where you've got the 12 Reserve Bank presidents coming in, what that assures, really, it institutionalizes diversity of thought. So we get different people coming in who've got different backgrounds, different careers, and they think different ways. And I think that's enormously beneficial to our decision-making process.
So there has been discussion recently about the Fed, some Fed members, Fed board presidents selling their securities and maybe not doing everything they were supposed to do in terms of disclosing it. What have you done to fix that process?
We put a new system and a new set of rules in place, which I think are best in class for a public institution like the Fed. And the innovations were that if someone wants to sell something that they own or buy something, they have to clear that in advance with staff at the Board of Governors, and then you've got to wait 45 days for that to execute. Also, you can't own individual stocks, and you can only authorize these transactions or execute them during specific times. And and we just, of course, all of these are disclosed. If your idea is to go to trade things, buy and sell them because you think this stock is cheap and that kind of thing, that's just not something that will work.
So what is the salary of the chairman of the Federal Reserve Board?
It's around $190,000, I believe.
Okay, so you live on the $190,000. If you need to sell something, what do? You have to clear it for 45 days, or?
That's right. If we have family expenses that, if we have them, that exceed my salary, then we have to sell an asset.
You think that's fair salary for the job, or?
I do, yes.
No. Okay, so today, how do you coordinate with central banks, let's say in England or Japan or China? Do you have regular conversations with them about what they're doing?
We do, and I meet 6 times a year in Switzerland with the heads of of many central banks, even the small and medium-sized ones in Basel at the Bank for International Settlements. In addition, among the major central banks, I have regular dialogues going with most of them. And so what we're talking though about is really what's happening in the economy and how are you thinking about policy and that kind of thing. It's very important that we keep those discussions going, because particularly in a crisis, you're going to need to know each other, and you're going to be able to trust each other.
And do you think the U.S. economy is pretty much in control of its own inflation rate, or are there events outside the United States like what China is doing or the Ukraine war that are affecting inflation and make you nervous about where inflation might be going?
We have the tools. The Fed has the tools to achieve our 2% goal over time. But inflation in the United States is, of course, very closely related to things that happen here, including the balance between supply and demand. It's also affected by, for example, commodity prices that are really set on the global markets. Oil and main agricultural commodities are priced globally. So there are certainly, it's an integrated global economy and global markets, and we are part of that.
So you get data from all the various government agencies, but do you ever use anecdotal things, like you go to the supermarket and you see the prices are high and you say this price is high? Or how do you ever get anecdotal things, or people ever call you up or friends and say, by the way, you should do this or that? Do you ever get that kind of information, or do you only get it from the government reports?
I mostly get data, but I will say I do believe that anecdotal information is very useful. And one of the things the reserve banks are great at is all 12 of them have big operations where they talk to businesses and nonprofits, universities, every sector of the country and the economy, and they bring that back to the FOMC meetings and they talk about what they're seeing. Because often, staring at data is great, but you need to have a story, and I think hearing the stories that people tell, it does help me to sort of assess what's going on out there.
So as the chairman of the Federal Reserve is obviously an important job. How do you reduce the stress level you have? I mean, you can't be watching economic numbers all the time. So
what do you do to relieve the stress other than interviews like this?
You know, the usual things. I read pretty light fiction, detective and spy fiction. I exercise as much as I can. As you know, I like to ride my bike. I play the
Is that
guitar,
safe?
play music.
Wait a second, is that safe riding a bike? Dangerous and
It's safe. Sorry, it's safe if you stay on the bike, and
okay, you're good at that.
that's what I try to do.
And you still play the guitar, or
I do. Yeah.
Your hair is awfully short for playing the guitar. Don't you need longer hair? Or was your
Yes.
hair longer when you were younger?
It's grayer. It's too gray too. So.
Okay, so let me ask you about the issue of what it's like to be chairman of the Fed. You can't go have regular friendship kind of dinners or meetings. Can you? People treat you much differently, I assume, than they used to, right? When you go to a restaurant, are people listening to what you're saying or something like that?
I have always thought that my jokes were funny, David. But no. Yes, it's I've never been a public figure before like this.
Recording in progress.
It's a great honor to serve. But yeah, when you go in public places, you have to be very careful about.
And
what you
does the
do.
president of the United States ever call you with any advice, or you don't realize did President Trump ever call you, or President Biden ever call you, or?
Well, I think it's a matter of public record that President Trump did used to call me from time to time.
What did he call you?
No, I haven't had that kind of. I haven't gotten any calls from President Biden.
Okay, so the biggest challenge you have now is being able to keep a straight face, not telling people what you're going to do in the future, and look at the data and then come up with the right solution, right? That's mostly it.
I think the biggest challenge we face at the Fed is completing the process of getting inflation down to 2%. And what I want to point out is that we're seeing disinflation in the goods sector. We expect to see it in the housing services sector. And these are the three parts of the core PCE inflation index that we look at. There's 56% of the economy, which is the rest of the services sector. It's the biggest part, obviously. And we're not seeing disinflation there yet. And that's going to take some time. And we need to be patient. And we think we're going to need to keep rates at a restrictive level for a period of time before that comes down.
So when you made your speech the other day, when you talked about the Fed discount rate, you used the word disinflation 11 times. Not that I'm counting, but 11 times. So you were saying that disinflation is beginning to appear. Would you use that word 11 times again today after the jobs report, or you would be less inclined to use that word so much?
I might use I might say it. I would certainly use the word disinflation, yes, which means declining inflation, and I would call it declining inflation too.
And today, what about the total debt of the United States, which produces some inflation, 31.4, leaving aside the debt limit? Are you worried about the total indebtedness of the United States producing inflation, or you don't think that's a big problem?
Yeah, it's not the level of debt. I would say the thing I'd say about the level of debt is really, it's not. First of all, it's not the Fed's job, but I would say that we're on an unsustainable fiscal path at the federal government level. That has been the case for some time, and it's something we will have to deal with. And it's better to deal with it sooner rather than later.
Now, many of your predecessors were economists. You're trained as a lawyer. They spoke in what I call Fed speak, which is to say incomprehensible kind of economic language, which was done intentionally, I think, sometimes they would say. So you tend to speak in English. Has that been a plus, you'd say, when you're dealing with members of Congress, they can understand what you're saying?
I like to think so. I've made it a real priority to engage a lot with Congress. In our system of government, unlike the parliamentary system, our accountability is to the legislature. It's to Senate and the House, and particularly the two oversight committees, Senate Banking and House Financial Services. And I think it's very important that we respect that and explain what we're doing and listen to their concerns and share with them how we're thinking about things. And I think they appreciate that. But that is, we have this precious independence. We can't be removed from office. We serve these long terms. The other side of that has to be accountability. And the way for us to get accountability is to be as transparent as possible and try to reach, the people of the United States through their elected representatives. So this is a very high priority, and we're going to keep doing it.
So when you testify in front of Congress, how much time does it take to prepare for that? Is that a 1 hour preparation session, or is it a 1 day session, or a 1 week session?
These are supposed to be monetary policy hearings under the Humphrey-Hawkins Act. And they're actually on anything that's any political issue. So it's quite extensive. You have to prepare for everything that the Fed is involved in and many things that the Fed is not involved in. It's a lot of preparation.
So when you get questions from some members, you have to bite your tongue and say, why are you asking a question like that? Or you never have that problem?
That never happens.
Never happens. Okay. 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 All right. Well, good. So today, as you look at the country's economy, what is the biggest worry you have about inflation? Is it just that the fiscal policy is not completely under control? We have exogenous events outside. What is your biggest worry about inflation today?
Well, it's kind of what I was saying earlier, which is we're just at the beginning of this process, right? Goods inflation. So we need that process to continue. Goods, the whole thing began, the whole inflation began with people not being able to buy services, instead buying goods, and then global supply chains collapsing. And so you couldn't get goods and prices of goods went up, and that's where it started. But that is now starting to get better as supply chains are improving and as people are rotating their purchases back to services. You move on though, we're not seeing it yet in housing services, which is either rent or the ownership, the imputed costs of house ownership. But we expect to see that. So we need that to happen. That's another big part of the economy. It's got to come. It should come in the second half of this year. Then the biggest piece of it, and what I worry about the most, is when are we going to see disinflation or declining inflation in core services ex housing? So that's what I worry about. The last thing I worry about is just another exogenous event. It's a risky world out there, with the war in Ukraine and the reopening of China, and those are things that can affect our economy and the path of inflation.
Right. So the balloon was not your worry, though. You don't care about the balloon.
It's not within our ambit.
Okay. So today, the Federal Reserve gets data from all over the country, and are you convinced that you get the best data, you have the best data collection methods, or do you think it's not as modern as what Wall Street gets?
So most of the data that we get are just the same. We don't collect the data on unemployment or inflation or most things. So most of that's just government data, and a lot of that's, for example, very high quality. The labor market data is very high quality. What we get, which I think is better and different from what everybody else gets, is what I mentioned earlier, and that is the reserve banks putting together the beige book,
Beige book.
the beige book, putting together the beige book, and also coming in and sharing the anecdotes and what they're hearing, what's happening with each district is different. You have agricultural districts and energy districts, and so that I think our anecdotal, but also just the haul of information we get through that network is I don't think anybody else has that.
So do you consult regularly with some of your predecessors? I mean, obviously one is Secretary of the Treasury now, but Ben Bernanke, for example, or?
I do. I talk to former Chairman Bernanke. I talk to, Secretary Yellen. I still talk to Alan Greenspan now and again.
And when you're dealing with your colleagues on the Fed board, and you disagree with them, do you say, look, I'm the chairman of the Fed, I am the person who has to make the final decision, and this is what we should do, or you don't quite do it that way?
It's a process of reaching agreement, and I hear what people have to say. I tell them what I think, and then I'm the one who has to bring a proposal in front of the full committee, not just the board, but in front of the full committee on monetary policy. And it works. We have to reach an agreement, and we get to a place. I think you can tell today we are blessed with a diversity of perspectives on the FOMC with 19 people. Of course we are, but you have one thing that unites all of us, and that is a very strong commitment to getting inflation down.
So in some parts of Washington, people say, if you give me this, I'll give you that. I'll trade this for that. You never do that at the Fed when you're coming up with a decision. I'll do what you want if you do what I want. That doesn't happen ever.
Not really, no.
Oh,
No.
okay.
Like you mean a better office or something like that?
Well, just, I'll say what you want me to say if you say what I want you to say or something. That never happens, right?
No, it doesn't happen. I mean,
And when you want to talk to members of the board, of the Federal Reserve Board, do you go to their office or do they come to your office?
I like to do both. I
Oh.
mean, I really don't like to sit in my office all day and have people come to see me. I like to go barge in on people, and I think it's much better to get up and walk around and see people.
The Fed has been pretty good at avoiding leaks of its decisions. How do you do that? Because most people in Washington are not so good at that. How do you avoid leaks?
We
of what
do
you're
have,
about to do?
we've got very strict rules around confidentiality, particularly around the written materials that we have. We publish these things internally for the FOMC meeting, the memos and the teal book and all that. But the other thing to remember, though, is, we're not trying to hide our decisions from the public. We actually, in modern monetary policy, we want the public to understand how we think, how we're thinking, and if markets really understand how you're thinking and a new piece of data comes in, the markets will go, well, they're going to do this, and it sort of happens organically. And that happened all last year as we were, talking about raising rates. The market priced in rate increases long before we actually enacted them. So it's not, we want to be transparent. We're not looking to surprise markets with these decisions.
But from the time that you make your decision on the FOMC, whatever time it is during the day, and your press conference at 2 o'clock or something like that, or
2:30.
2:30.
Yeah.
So your decision is made by 2 o'clock or whenever it is, or something like that. So you got a half hour, but you have to avoid leaks during that half hour because that's very market sensitive information. How do you make sure nobody is calling their spouse and saying, guess what we're going to do?
Well, people take this very seriously. None of that happens. You're taking your professional life in your hands if you do something like that. I think people have a sense of self-preservation. So people are very careful about this information. There is a period of a couple of hours after the meeting and until we announce the decision, but we announced the decision at 2. The press conference is at 2:30. So I think, it's a fairly small group of senior staff and policymakers that kind of know what happened and what we're going to say. And I just think everybody understands that you've just got to be really careful with that.
To go back to jobs discussion, if next month you had another 519,000 jobs created, net jobs, would that be good or bad from your point of view? Have we a lot of people working, but maybe producing more inflation?
So we don't have the luxury of thinking about good or bad. It just is what it is. So, but I would say again, most analysts, most economists would say that to get inflation down from high levels that we've had, if you look at history, there is some softening in labor market conditions that goes along with that, and that is still, very possible and indeed likely here. Some softening in labor market conditions. However, this cycle is different from other cycles because of where it came from, and it's just confounded all sorts of attempts to predict what it would do. So it is good that we have seen very strong labor market, but at the same time, we're seeing wages moderating. Wage increases are still very high, but wage increases have come down to a level that is closer to what would be sustainable, still well above what would be sustainable with 2% inflation. And same thing with inflation. Inflation is starting to come down and the labor market hasn't softened. We do expect that it will soften, but it will do what it will do. Our job is to get inflation down to 2% and preserve maximum employment.
So when the FOMC meets, as it does regularly, eight times a year,
Yes.
8 times, you pretty much know how the decision is going to come out before you actually get together because you've been talking to each other? Or does the meeting of the FOMC change minds in ways that you might not have expected before the meeting started?
It depends on the meeting. I talk to each of the 18 other participants at least once, and we go through everything. What's your analysis of the economy? How are you thinking about monetary policy? How are you thinking about the path forward and all of that? So in some meetings, I will say some of the time, you get into a discussion at the meeting which suggests that maybe you should communicate differently. And then we'll think about that. And we might actually take a break in the middle of the meeting and then go off with a smaller group and think about that and come back and make changes. Sometimes, though, everything plays out as expected.
And when you're having these FOMC meetings, I assume somebody sweeps the room to make sure there's no bugs and anything.
Yes, all that.
So no leaks.
No.
Okay. And today, as you look forward, as we are going forward for the next remainder of this year, your basic view would be you'd be happy if the inflation rate were to get down by the end of the year to 2%, may be unrealistic, but your core inflation now or overall inflation, you think is about 4.5%, something like that, or what would you say it is?
It's in that range. There are different measures.
Okay.
Yes, we expect significant progress on inflation this year, and again, it's our job to produce it. And I want to say again, we throw these numbers around, but the reality is we're going to react to the data. So if we continue to get, for example, strong labor market reports or higher inflation reports, it may well be the case that we have to do more and raise hikes more than is priced in.
So if I wanted to go get a mortgage on a house I was going to buy, for example, you would say I'm not going to be any better off waiting till next year than now because rates aren't going to come down that much at the beginning of next year. So I might as well get the house now, mortgage.
So surprisingly enough, I get a lot of requests for advice on those kind of things.
And you don't give any?
And but I really can't.
Okay.
I really can't respond.
So, okay, so on the whole, to summarize where you are, you're basically saying that the jobs data that came out was a little bit surprising, but in the end, you've taken into account and you're pretty comfortable with the guidance you gave last time, and you're not prepared to give anything that's completely different guidance than you gave last week.
Well, I mean, this is a world in which we've had the labor market report, and I think that does. I think it underscores the message that I was sending at the press conference and in the meeting, that we have a significant road ahead to get inflation down to 2%. And I think there's been an expectation that it'll go away quickly and painlessly, and I don't think that's at all guaranteed. That's not the base case. The base case is for me is that it will take some time, and we'll have to do more rate increases, and then we'll have to look around and see whether we've done enough.
Okay. And 2% is the rate we had for the last 25 years before inflation came along. But prior to that, for most of US history, we were higher than 2%. Is it that 2% we're now so used to 2% after 25 years of it that you think that's the appropriate level?
So we went through this long period where inflation was really anchored around 2%. And we think that, and economists think that that's because people start to expect 2% inflation. And inflation, it's in a way, if everyone expects that prices are going to go up, prices and wages are going to go up 2% per year, then plus productivity in the case of wages, then it will. That's what'll happen. Having price stability, real price stability for an extended period of time is just enormously beneficial to the public, because you can then, on the back of that, you can build a very strong labor market, as we had a labor market with really 3.5% unemployment in 2018 and 19. And we had inflation running, just barely getting to 2%, wages moving up the most for people at the lower end of the spectrum. And so this was we all want to get back to that place, but the bedrock of the whole thing is to get inflation under control.
The unemployment rate hasn't come down as much as people are going up as much as people thought. In part, some people say because we don't have as many immigrants coming in the country, legal immigrants coming in, taking some of the jobs that otherwise would take. Do you think immigration is an issue in terms of giving us more labor workers, or do you think that's not a factor?
So just as a matter of arithmetic, it was a factor because there was very little migration across borders during the pandemic. And that was part of what was happening, particularly in certain sectors like the agricultural sector and food service and things like that, where there just weren't the people. However, just very recently here, the immigration data have turned up again. And I think that may be part of why people are feeling somewhat less pressure in the labor market to find workers. This is an issue not for the Fed, though. Immigration is obviously a political issue. We do not seek to be a player on this. But it's just a fact, though, that right now the United States has fewer available workers than it has jobs plus job openings.
And when you increase interest rates, the traditional effect is to increase the value of the dollar versus other currencies. Do you have any concern about the value of the dollar going up too much, or that's not something you comment on?
So the responsibility for the exchange rate really rests with the Treasury Department and the administration, not with us. Of course, that's another financial variable that goes into every economic model, but we don't look at it as something that we're working on.
All right. Well, I think I haven't been able to get you to say anything you didn't want to say. I would say, Jay, I've known you a long time. I think you've done a great job in a difficult situation. I appreciate your service to the country at $180,000 a year, or whatever the salary is, something like that. So thanks very much for being here, and thank you for your service.
Thank you, David. Great to see you. Thank you.
All right, guys. So that is the Jerome Powell press conference. Again, we're still green relative to when the press conference started. I just see a lot of emotion in chat. I see a lot of emotion. Any red candle, ah ha ha. Any green candle, ah ha ha. Like, the reality of it is we're still pretty neutral from we're still pretty neutral from when this started here. We don't really have any big, broad, like crazy crashes, crazy big rips. Market's still very green over the last 10 days. I see a lot of people who have basically been calling the market short, getting upset. And again, maybe it's justified, maybe it's not. The real thing to watch is kind of Apple. Apple moves the S&P 500. You see the S&P 500 getting closer to 413s. Here's Apple right now. Apple is kind of bouncing back and forth, still above VWAP, still holding trend. And again, we'll see what happens, guys. We'll see what happens. We did break 99.5K. So listen, if you could all take the time, we are so close to 100,000. So close. We are less than 500 subs away. We get 400 subs. 300 subs right now. We will get very close and we'll probably hit it on the weekend. So thank you guys so much for joining me. If you haven't already, hit the subscribe button, guys. We're pushing towards 100K. We're trying to hit it this week. We cover free stock market data. So we cover jobless claims, retail sales, CPI, PPI, Jerome Powell press conferences, rate hike decisions, and all that stuff. We cover it completely live on this stream. We try to stay unbiased. And again, we try to just be honest with people about, what we see the market. A lot of people are doom and gloom. The market's going to crash. The market's going to rip. I'm not really on either of those, bandwagons. I'm just kind of neutral on what happens to the market. So again, hit the subscribe button if you haven't already. Hit the notification bell. We are going to be doing a crypto show today, talking about the latest news in crypto. And so again, guys, if you haven't already, hit the subscribe button. Also, guys, check out our sponsors. I'm definitely biased in their favor, but check out Top Step. If you look at, say, the E-mini, and then you look at the SPY in futures, they do the same thing. It's the same price action. You get a big rip up. You can trade this middle one here with no PDT restriction. So I see a lot of people trading penny stocks. You can day trade futures without the PDT rule. There's no PDT in futures. You can day trade short, essentially the S&P 500. And if you want to test yourself, try out Top Step. It's a funded account program for futures. They give you a demo. If you can hit the target on their demo while following their rules and conditions, and they fund you between 50 to 150K. Most people are not going to be able to get funded. I always try to stay transparent because most traders lose money, but it's a beautiful way to test yourself without risking a ton of money. The base package is $140. If you pass it, you get a 90% split with funding. If you don't pass it, you're only down $140. If you took the same swings in a real account, you would be down much more. And so check out the link. It's right there in chat. Help support your boy here. Help us get to 100K. We're pushing towards it. Also, guys, we're going to end the stream, immediately pivot to our crypto stream. So if you haven't already, again, hit the subscribe button. It should immediately bring you to our crypto stream. Guys, it should immediately bring you right on over to our crypto stream. And so again, I'll ask one more time, hit the subscribe button. We're almost to 99.6K. So we only need about 400 subs for the rest of this week, about 400 subs for the rest of this entire week. And we'll hit 100K this week. That's a beautiful thing. And so again, if you haven't already, hit the sub button, hit the notification bell. We're going to start our crypto show. So we will be over there right now, starting the crypto show. And again, it should immediately pivot you to the crypto show. We'll see you guys over there. Love you all. Y'all be safe. Thank you guys so much for the support. We got a crypto channel. We're starting that stream now. Again, if it doesn't bring you there, again, subscribe to this channel. If it doesn't bring you there, go to youtube.com/beginnercrypto. youtube.com/beginnercrypto. Here is that link if you want to check it out. And again, we'll see you guys over there. It should immediately pivot you to the stream, though. We should end this stream, and then it should immediately bring you to the crypto stream. And so again, we will see, but I'll see you guys over there. Again, one more time, subscribe. Thank you guys so much. And we'll see you guys over there. Good luck, guys.